Morning, everybody. I really do want to thank you all for taking the time to be on the call today. Our goal today is to help you to change the conversation about LTC from an expense to an asset. Okay, so we're going to talk about how to start the conversation, how to overcome common objections, and also how to explain the unique benefits that a life LTC combo product provides. So we will spend a good portion of time on how life insurance can be used in this mix, because at Milner, we feel that these products will continue to become more prevalent in the market due to the variety of benefits they provide, and we want you to be at the forefront of this growth. So let's get into it. First of all, what's the need for this chronic illness care? So statistics show the need is greatly increasing, okay? Statistically, 7 in 10 people who reach 65 will at some point in their life have a need for chronic illness care. Okay, we're kind of seeing this big increase happening. We've had carriers, traditional long-term care insurance carriers, having to dramatically increase the price of their products, right? And that's because this need is increasing. Okay, so there's a huge market. Now, there's a lot of money spent too. U.S. spends nearly $725 billion a year on chronic illness care. It's a huge figure, okay? That's a lot of money, but where is most of it coming from is really the question, okay? And as you can see on my chart there, most of the care is actually provided by family members. Most of that money is coming from family members' pockets, okay? Or they're just taking care of mom and pop, which of course in itself is a huge expense. All right, now private LTC insurance, that's actually the lowest on this list. That's kind of concerning here. Medicaid is a pretty big one, but then again, a lot of your clients are not ever going to qualify for Medicaid. This is not really a position you want to be in. I mean, this would not be my straight up plan, as I want to eventually be on Medicaid, right? And it's not meant to be your plan to end up on Medicaid. So we're finding that most of the care, by and large, $450 billion out of $725 a year is being provided by family members, unpaid. So there's a huge opportunity here. So what does that mean individually? So right now, the average cost nationwide for assisted living, $43,000 a year for assisted, nursing home, $82,000. Now, of course, nursing homes, that's usually a shorter stay. Assisted living, though, could be several years. So there's a big expense individually here for being able to attend these facilities. So we have to come up with the money somehow. So how do you start this conversation with your client? Now, talking about LTC needs, I think it's actually a pretty easy conversation to start. Not an easy product to sell, but an easy conversation to start. 2 questions. Has anyone in your family ever had a need for care? Now, between siblings, parents, grandparents, extended family, pretty much everybody is going to be able to say yes to this, and is going to be able to say yes more than once. And how was that handled? Now, you'll probably get a few different types of answers to this question, and I think that any one of them is helpful to you in starting this conversation. You might get the answer of, well, they ended up running out of money, ended up going on Medicaid. They weren't in the best place. They were taken care of, though, but not really, what we would have wanted for them. Or, we ended up taking in our father, and it was, we love him, and it was a good situation. We're glad we did it, but it cost a ton of money. It was really stressful on us. It would have been better if we could have had him in a different facility. Or maybe the rare situation, statistically, Granddad had a LTC policy. He stayed at a really nice place. It was a great time. We're really glad that that we had that coverage. Any one of those 3 scenarios gives you an in to talk about the importance of long-term care insurance. Either they didn't have it and they needed it, or they had it and they had a good experience with it. So once you've started the conversation, we see three common objections, okay? It's too expensive. What if I never need it? And the third one, I plan to self-fund, okay? Very common objection. I'm sure you've all heard them several times if you sell long-term care insurance. So let's look at them. First of all, it's too expensive. My follow-up to that would be, well, can you afford not to do it? Right now, assisted living is averaging basically $3,600 a month. So say you need it in 20 years, with the average 3% inflation that's going on with medical care, that's going to be $6,500 a month in 20 years. A nursing home, twice that much. Okay, so that's going to be a huge expense. Can you afford not to? What if I can show you a way where this small premium, relatively, that I get you to put into a life policy with a long-term care rider, what if I could show you how that will become an asset for you if you never use it? Okay, so you're not giving money away. This is not an expense for you. You're just allocating money to a different account. Would that change it? And that goes right into the objection of, what if I never need it? Well, great. I would be happy if you never need it. That's a great reason to use life insurance. Okay, so how would your clients feel about being able to put money into an account where if they never need it, they end up getting a 5% return at life expectancy, guaranteed, that passes on tax-free? They would probably feel okay about that. I know I would feel okay about that. Maybe I could have earned a little bit more somewhere else, maybe, but I did not have to worry about that money, and that was 5%. So that's pretty good. And if I did have a long-term care need, I had a pool of money ready and set aside to take care of that need. I would feel pretty good about that. Or third objection, I plan to self-fund. My response to this would be, okay, but why? Why would you want to do that? Most people behind the scenes, you have to think, what are they thinking when they say, I plan to self-fund? They're probably thinking that long-term care insurance, well, you know, I'm saving plenty of money. You know, I'm probably never going to need it. That's what they're thinking, even though statistically they probably will. They're not thinking statistically. They're thinking, I'm never going to need this, and if I don't need it, I'll be way better off financially if I just put my money in, you know, the investment accounts that I'm doing, and then I can just pass that money on to my kids, okay? Now, let's look at it mathematically. Let's say we have a male and female age 45, really good health. This is pretty early to start the long-term care conversation. It's a great time because you can get in really cheap. But here's the scenario I'm looking at. What if you could give me $500 a month, and I could turn that into a $730,000 pool of money, okay? Which is, this is a survivorship contract I'm talking to them about, which is $7,300 a month each. Each one of you on this survivorship contract gets $7,300 a month in long-term care need coverage if you need it. If you don't need it, it passes on to your beneficiaries as $730,000. Say you use a portion of that. The rest of it passes on tax-free, okay? What does that turn into at life expectancy? That's a guaranteed return of 5% at your life expectancy. I've taken care of your need. I've insured you for this entire period of time. If you never need it, it's a 5% return at life expectancy. If you do need it, it ends up being a lot more than that, okay? So that's a big deal. What would you have to do if you were just to self-insure yourself? Well, let's say you put $1,000 a month into an account, and let's say you have long-term care needs at age 70. You would have had to put $1,000 a month into account, twice as much as I'm talking about, and you would have had to earn 6% every year average, okay? So, and you would have been uninsured basically from the period of time between 45 and 70. So I would just say, when your client says they want to self-insure, let's just look at the math, if we can. Look at the math and see why or why not that would be a good idea. All right? I think the math will tell a good story for you. So that's kind of the introduction of what we think is a effective way to talk about long-term care, to introduce the conversation. And at this point, you get to the point where you have to start knowing what's available. That's one of the main benefits we can help you with here at the Milner Group, is helping you navigate the sea of products that are available and make the best recommendation for your client, because there's a lot of different stuff out there, and it gets kind of confusing when you get into it. But we can explain it for you. There's two main types of riders. There's the chronic illness type, right? And then there's the ones that are actually called long-term care. And there's some variations inside. For the chronic illness, there's the extra charge ones, like Protective and Prudential have these. You pay an extra fee on top of the life insurance policy premium. I found that it's normally about 15% for men, with increase about 20% more for women over what the base guaranteed UL premium would have been. Okay, these work exactly like the long-term care riders, almost. I'll talk about a distinction later. There's then the free type. These are the ones that just come tacked onto the policy for free. Sounds great, and it is for some people, but we'll talk about why it's different. Within the long-term care type riders, there is indemnity versus reimbursement payouts. I get a lot of questions about those. Now, chronic illness riders, to clear it up, they are always indemnity, never reimbursement, okay? LTC can be either indemnity or reimbursement. And I'll talk about the difference there and give you an example so it's crystal clear. So let's talk about these different types of riders. The chronic illness extra charge type rider, I think these and the long-term care riders, they definitely provide the most value for your client. Now, they cost some money, but they're definitely what you would want if you ended up having a long-term care need. Now, most of them are going to pay 2% of the death benefit per month. A lot of information I'll just go through quickly here. The nice thing is, when you start taking benefits, it reduces your death benefit dollar for dollar, okay? That's key. Say that you took $100,000 out for long-term care over time of your 500K policy, you're passing on $400,000. This is very easy to explain to your client, okay? The freestyle rider we'll talk about, not easy to explain to your client. Your cash values are reduced proportionately if you have any cash. 100% of your death benefit available for acceleration. There's no discounting, okay? Premiums, I get this question all the time. The premiums, you're not paying premiums for this while you're on claim, and the policies are guaranteed not to lapse. All of the no-lapse guarantee policies are guaranteed not to lapse while you're on claim, at least all the ones that we have that I'm aware of. Now, that does not mean that cost of insurance ceases. It means that if you stay on claim, they're guaranteeing you they will not lapse this policy on you. Now, say that you suddenly got better. Very unlikely, right? You 2 out of 6 ADLs, you're not likely to just get better unless that was some sort of accidental thing, like you're in a car wreck or something. You wouldn't qualify for this rider anyway. You wouldn't if that was the case. But say you came off claim. That could negatively affect your no-lapse guarantee provisions, because at that time they're going to say, well, the cost of insurance kept going and you weren't paying premiums. That's not a problem when you're on claim because we guarantee it won't lapse on claim. But if you came off claim, then you may have to make a make-up premium. I just bring that up. I think that's not going to happen, but I bring that up because I get the question a lot. Okay, how do these riders look? So here's an example. You become, the condition has to be permanent. That's really the difference between these and the long-term care riders. Physician has to certify that the condition is permanent. That's the difference between chronic illness and long-term care riders, basically. Okay, the client has a $250,000 death benefit, eligible for 2% a month. Their premium payments are suspended. They receive $5,000 a month for 30 months and then dies. The beneficiaries will receive $100,000, right? Okay, very easy to explain. The $250 minus the $150 they used, they pass on $100. I love these riders because of the simplicity to explain to the client. All right, the free riders, not simple to explain, but it's nice to have that on there. It is a nice kicker to be able to tell your client, well, if you ever need it, you've got this chronic illness thing on here that can help you pay for your chronic illness, quote, LTC needs. All right, but don't try to tell them probably what they're going to get, because that's really you're not going to be able to. You can typically accelerate up to 24% of the death benefit per year, subject to the per diem limit. Rider's free, but the charge when exercised is really what gets you, okay? And I think this is going to end up being a bigger cost than it would have just to buy one of the nice riders. So the amount received is very tricky. Depends on your age of diagnosis and the severity of the condition. That means your projected life expectancy is what they're trying to get at there. The max percentage of the death benefit the carrier allows, a lot of times it's around 90%. Whatever they use to value their money, their discount rate, let's say 5%, and an administrative fee, $150. Little side note, premiums typically continue on claim for these, but they're reduced proportionately to your death benefit. So say you take $100,000 out, well, they're going to reduce your premium by whatever that $100,000 cost. Okay, so you still have a premium, but it gets reduced continually as you take money out. Okay, let's look at how you would calculate this. So you qualify, you elect to take 24% of your $250,000 death benefit, $60,000. Carrier calculates your life expectancy at 5 years based on whatever your health is, whatever you got going on. They charge 5% for their money. The policy actually pays you out $46,861, which is that $60,000 divided by their time value money calculation here, minus the administrative fee. You get this amount, $46,861. Your death benefit is reduced by the full $60, and you got $190 left. Okay, it's not that complicated, but probably not explaining this to most of your clients. And there's no way you can take care of this life expectancy calculation because you have no idea what their condition is going to be. Okay, so it's a nice rider to have on top for free, but I just bring this out because it's not really comparable to the type you pay extra money for, the extra charge riders. Okay, the long-term care ones, I'm not going to go through all of this. I will say that a 90-day elimination is typical. Typically, they're going to require you to have a plan of care from a doctor written up. It does not require a diagnosis of a permanent condition. Okay, that's the big difference between these long-term care riders. A few companies have them, like Nationwide has one, Minnesota Life has one, John Hancock has it, Genworth used to have one, the true long-term care riders. Most companies are actually on the chronic illness style. What's the biggest difference? Requiring a diagnosis of a permanent condition. So there could be scenarios where this is actually more beneficial to your client, but I don't see a lot of them because this is kind of, requiring that 2 out of 6 ADLs you're unable to do it. How often is that going to happen and you're going to get better for it? Probably not very often. These policies are very similar. They typically state that they won't lapse on claim. They have 2 different payout styles, okay? Indemnity versus reimbursement. I would say most people are going to want indemnity, and most of the products are. But let me just clear up what that means exactly. So in the indemnity style, the benefits are paid up to the HIPAA per diem limit. That is a limit for taxation purposes of what you can get without having to show receipts, okay? So right now, it's like $10,200 a month, I think. You can get that amount without having to submit receipts to justify actual long-term care expenses. That's important. The benefits are payable regardless of total LTC care received, again, because receipts aren't required. So since receipts aren't required, you can actually get more benefit than you actually received, okay? As an example, $10,200 a month is the limit. Insured receives $6,000 of qualified long-term care. However, if you have an indemnity-style policy, the insurer can say, yeah, I want the full $10,200, as long as his policy is big enough for that. And they'll give it to him. He can use the $4,200 for whatever he wants. He can go on a big trip with his family or whatever he wants to do. He can take that money and do anything with it. He does not have to justify it, okay? The other thing about this type, typically the indemnity type, is you can typically, because you can use it for whatever you want, some people are going to say, you know what, I'd like to stay in my own home, and on top of that, I'd like to have a family member take care of me. You can say, no problem with this type of rider. Great. You have a daughter that you think is qualified to take care of you. You'd like to reimburse her for her time. Great. You can take this money out. You can pay it all to her if you want. We're not going to look over your shoulder and tell you you can't use the money for that. Okay? That is a huge psychological benefit of these type of policies. The reimbursement ones, you have a lot of strings attached. Okay? You have to put, submit all your receipts to justify the amount. The benefits paid are not going to exceed what you've actually incurred. And on the other side, the amount you can get is subject to the total amount of care you received instead of the HIPAA per diem limit. Now, that can go either way. So you might get less than the HIPAA per diem. You actually could get more than the HIP per diem limit if you justified it with your expenses. Okay, that's really the only upside I see of this type of policy. So in this case, you qualify for a claim, you incurred $6,000 a month, plan pays $6,000, even though let's say $12,000 was available under your plan. Okay. On the flip side, say the HIP per diem limit is $10,200, you have receipts showing expenses of $15,000. You actually could, if your policy justifies it, you actually could get $15,000 of reimbursement. Okay, because it's reimbursement, not indemnity. So I hope that made it clear the differences between the two types of payouts. All right, I kind of wanted to wrap this up with a story here from one of our advisors to kind of show the psychological importance of long-term care coverage and why it's important for your clients to think about it. So one of our advisors told us a story that he had a tax attorney friend, had a wealthy older client. So client got sick, ended up moving to an assisted living facility, and the tax attorney went to visit the client and was somewhat shocked when he got to the facility because he expected that his client would be in the nicest place around, but he was actually in a very low-end facility. And so when the tax attorney asked why, he's given the response, "This is the cheapest place I could find." So why would somebody who has plenty of wealth opt to go for the cheapest place they could possibly find? Probably the answer to that question is that the client was trying to maximize wealth transfer to kids, okay? And trying not to have a feeling of wasting money at the end of life, okay? What if that client had a specific money put aside for that LTC need, could focus on finding probably the best place within his budget, the long-term care budget, rather than finding the cheapest spot available? Okay, so that's why we think it is important to help your clients to visualize their future self so that they can see the future impacts that their decisions today are going to have on themselves. All right, that pretty much wraps it up for today. Like Michael mentioned, please give us a call. Any of us can help you out if you have a specific case about understanding which rider would be the best, which product's going to have the best price, how it's going to work. We can help you out with all the little details, and that's what we're here for. So at this time, I'd like to open it up for questions. You should have a place to type in questions on your screen. And if you do have any questions, they'll be read to me, and I will do my best to answer them.
All right, thank you, Jake. I'll wait on questions. I do see a couple of people are raising their hand. If you've got your hand raised, just go ahead and type the question into the question box on the webinar screen, and we will get the question asked to Jake. All right, I've got several questions. Jake, one specific question is you may or may not be able to answer. Do we have access to Nationwide's LTC product as well as Nationwide's LTC rider?
I don't know that. I assume we do, but I don't know that. And if you, Michael will write down the name of the person who asked that question, and I will have our long-term care specialist contact you.
Okay. All right, next question. Just in terms of process, if somebody thinks this may be of interest to a client, can they just give you kind of a birth date and some general information about the client and let you and your team work through some suggestions for that client?
Absolutely. We do that all the time. That's what we're here for.
Okay.
And another thing is, you know, if you want to have somebody on the phone, say that you're kind of a little bit uncomfortable possibly on how these riders work, by all means, I'm available to do a conference call with you and your client. I do it all the time. I will be your advocate and just help you explain exactly how this works for your client.
Okay. Another question, is there is there a corridor amount on these policies, and is there any risk that going on claim could eventually bleed the death benefit completely dry and cause a tax situation?
There's not a risk of a tax situation, but like I mentioned on the type of rider you pay extra for, the long-term care and the extra charge chronic illness, they're available 100% of the death benefit. Okay, so basically you can use up to 100% of the death benefit, and then typically in order to have a non-lapse situation, they will have like a $10,000 death benefit left or something like that. Okay, same thing with the freestyle. It works differently, but typically they have it set up so that you can only take, like I mentioned, 90% of the death benefit or less. So you never end up in a situation where the policy is completely gone.
So one tax question, Jake. What are the tax implications of traditional long-term care versus using a rider on a life insurance policy? And is there any way that the long-term care rider could be treated from a, is there a partnership qualification where it could get treated the same way from a tax perspective?
That's a good question. So the traditional long-term care partnership qualified, obviously, depending on the client, the premiums could be tax deductible. That is not the case with the life insurance with long-term care riders. They're not yet partnership qualified. Even the ones that are labeled as true LTC and filed that way, they're still not partnership qualified. I don't know when exactly that'll happen or exactly what is holding that up at this point, but I have spoken with our carriers that haven't, and they're not qualified yet, and so you cannot deduct any part of the premium that you're paying for it.
All right.
I suspect, just to follow up on that, I don't suspect really. I would be surprised if you get to ever deduct that, because it's bound inextricably with a life insurance contract. So if you did get to deduct the premiums in any manner, you could end up potentially in a situation where you're deducting premiums and then you have a policy that pays tax-free as well. I just don't see that happening. Maybe, but I kind of doubt it.
Okay, well, we thank you very much for joining us today. Jake, we thank you for your time. Thanks for playing hurt. We certainly appreciate your effort. Our next webinar will be July the 28th at 10 a.m., and that'll be our next webinar in the Retirement University series that we have going this year. So we really appreciate you joining us today. We look forward to hopefully having you join us again next month. Thanks so much, and let us know how we can help you serve your clients. Thank you so much.